Hello, Prof Roy. My name is Michael Livinarto from International Finance class. So today I will told you about the mind map that I had made for the midterm exam. So here I I was planning to explain it in very detail in the mind map itself, but then I thought I'll just make it brief since I will also explain it to you. So yeah, let's just do it now. So the first one, let's jump into the first chapter, which is the foundation, the introduction first. What you're trying to tell in this section is that the foundation of international finance relies on a strong understanding of core corporate finance principles. Of course, before managing money across borders, a firm must master domestic financial management. And at its core, primary goal of a firm is value creation, which you emphasize a lot in that first meeting, which is driven by, of course, return on capital, growth, and cash flows. And in this context, cash is considered as king. You mentioned it's king because it represents the actual liquidity of a company to operate and, of course, to grow. However, achieving this kind of goal is quite complicated because there's this thing called principal agent problem. You mentioned this a lot, where managers basically will not act in the best interest of shareholders due to conflicting interests or asymmetric information. And you also mentioned in this section to monitor financial health, we of course use financial ratio. We categorizing them into profitability, liquidity, activity, leverage, and market ratios. This is what mentioned in your slide. We also have to consider the capital asset pricing model, which determines the required rate of return on a based on a risk-free rate and a risk premium. Now, finally, firm uses capital budgeting methods like net present value and internal rate of return to evaluate projects. And they must find the optimal capital structure that balances debt equity to minimize the weighted average cost of capital or WACC. Now, chapter two is basically we are going at the financial management two. You were testing us. You mentioned beyond domestic borders. We are also talking about multinational corporation or MNC, which basically operate in a vastly different environment than purely domestic firms. MNC operate through a very complex network of parent companies and foreign subsidiaries, interacting constantly with like a foreign exchange market, product markets, and international financial markets. That's what you're saying in this chapter. Now, naturally, engaging in international business increases MNC exposure to volatile exchange, rate movements, and the economic condition of foreign countries, geopolitical and political risk. Therefore, valuing the MNC is a bit more complex than the domestic one. MNC value is calculated by forecasting cash flow in various foreign currencies, estimating the expected exchange rate for those currencies, and then discounting those converted cash flows back to the present using the firm cost of capital. Now, the third one, we are forecasting that market and also forecasting the exchange rates. Now, to manage this international operation, MNC rely heavily on foreign exchange or forex market, which facilitates the international trade and investment by allowing currencies to be exchanged. There are several ways to participate in this market. In your slide, there's mention of spot market, which basically just immediate currency exchange. The second one is the forward market, which basically allows MNC to lock in a specific exchange rate price for a future date. Additionally, there's also a currency futures and options, which are used in hedging and speculation. Now, currency values fluctuate based on supply and demand for goods, services, and securities. The key drivers of these fluctuation include of things such as inflation rates, relative interest rates, relative income levels, government administration, and market risk perception. Now, the fourth chapter, we are talking about the parity framework. Now, this brings us to this very interesting chapter, which explores how international market correct inefficiency and establish equilibrium through arbitrage and parity condition. You were messing a lot. You were messing with us because you, of course, saying that is the market efficient or not. We were so confused, but honestly, it was very interesting. Basically, in this chapter, we look at the international arbitrage, which involves capitalizing on price disparity to make a riskless profit. You already test us for this. You ask in a quiz, and of course in the midterm exam. There are three type of arbitrage, which is the locational arbitrage. Ensure exchange rate uses rates are uniform across different banks. The second one is the triangular arbitrage. Ensure cross exchange rates to align properly. And there's also covered interest arbitrage, which ensures forward rates align with interest rate differences. Uh, Other than arbitrage, there are also three key parity theories here. The first one is PPP or purchasing power parity, which basically suggests that exchange rate movements are driven by inflation rate and differentiates between the two countries. If one country has high inflation, its currency should depreciate and maintain parity. The second one is the international Fisher effect, which posits that currency with higher interest rates will depreciate because of those higher nominal rates reflects higher expected inflation. Finally, there's the IRP or interest rate parity, states that the forward rate premium or discount of a currency should exactly offset the interest rate differentiate between two countries, preventing a riskless arbitrage. And the fifth one is the exchange rate forecasting. Basically, given all of these variables, MNC rely on, of course, forecasting to anticipate cash flows and make strategic decisions. Even though predicting currency is very complex, I know we tried, and none of us even got close to forecasting our expected our own rupiah forecasting. And of course, we uses things such as technical forecasting, which utilize historical data and statistical trends. We also use fundamental forecasting, looks at economic variables like inflation and interest rates. And some of us, I guess, also use the market-based forecasting, which use the current spot or forward rates as indicators for future expectation. And mixed forecasting combines multiple techniques, and none of us think of using the theory that you mentioned. So yeah, we kind of messed up. We are beaten by a simple theory. uh Basically, we must also consider the efficient market hypothesis or EMH, which categorizes markets into weak, semi-strong, and strong forms. If forex markets are semi-strong efficient, which they generally are, all public information is already priced into the current exchange rate, making consistent predictive and outperforms the extremely difficult. Now, the last chapter is chapter 6. We are talking about currency risk measurement and the conclusion before the midterm exam. Finally, we are, of course, operating in globally. For MNC, it exposes the specific vulnerabilities when currency values fluctuate. We categorize this exposure into three main types. We have the transaction exposure. Basically, the risk of future cash transaction will be affected by the exchange rate movement occurring before the transaction even settles. That's the second one is like economic exposure. This represents the broader and direct and indirect risk to a company's overall cash flow and global competitiveness due to the long-term exchange rate shifts. The last one is the transaction exposure. This is the accounting risk that occurs when MNC must consolidate the financial statements of its foreign subsidiaries into the parent company reporting currency. Basically, in conclusion, with all of these materials, mastering international finance requires a firm to, of course, build on its corporate finance foundation, navigate complex foreign exchange markets, understanding parity condition and forecasting to forecast future movements, and rigorously measure its exposure to global risk. And that is all from me, and that's all from the mind map that I made. Thank you so much, Prof, and have a great day.